Welcome to Make Your Wealth Work, the podcast where wealth becomes your greatest ally in achieving your dreams.
Here's a continuation of our previous conversation about approaching wealth with holes in your pockets. Why do holes in your pockets make any difference? Well, the Bible says that he that earns wages to put them into a bag with holes. That's the whole reference. Why would you put anything of value into a bag with holes in it? And the whole idea here is if you don't have your wealth program set up, whatever that looks like, your wealth profile, your financial plan, and then you go and make new money, you're going to put it into an old system, a broken system, a system that hasn't worked so far. And much of the problem with folks working from paycheck to paycheck is they haven't given real thought to their future. They haven't given real thought to the logic of where they're going, why they want to go there, how they're going to protect themselves into the future. So if you've been working for 10 years or 15 years or 20 years and you can't identify money that you've saved over a long period of time, then you're probably not choosing the wisest course. Now, you may be comparing yourself to your neighbor, whether that's your neighbor at work or another friend who has a business similar to yours or bigger or smaller than yours. And you're saying, well, my neighbor has more money than I do. Don't compare yourself to somebody else. Nobody else lives in your skin. Generate ideas to create new wealth and preserve wealth, protect wealth, grow wealth for your future legacy and your future generations and your future causes and charities that you can control, that you can protect. And think about exactly why you want to do that. This is serious work. This is hard work. It's hard work to make money. It's harder work to hold on to it. One of the biggest things that's killing their financial futures today is that they're living on debt. They're living on credit for all kinds of reasons and all kinds of excuses. So if you have a credit card balance and you carry that balance, don't ask me about what this new prospective idea is going to earn you, because you're losing 10% on your credit card. You're losing 15%. You're paying 20%. So you're already paying money to credit card companies for no good reason, because there's something wrong with the basic financial plan if you have credit card balances. Now, what about these money back credit cards? I get cash back. I get 1% back or 2 or 3% back on every purchase. So if you're going to carry a balance of $10,000 and your credit card is charging you 20%, let's just use simple math here. 20% of $10,000 is $2,000. That's per year for every year that you keep a balance. But you're saying, yeah, but I get 3% cash back. Well, 3% cash back is $300. They're paying you $300 so that you can continue paying them $20,000. Now, we're not going to go into the math here, right? But just look at the situation on the face of it. On the face of it, this is a bad bargain. It's a bad deal. This is fraud. This is a scam. People are stealing from you with your eyes open. Credit cards can be a poison. And in this particular case, I have to agree with some of those financial entertainers whose names I will not mention, and you know who they are, who will agree with me that carrying a credit card balance is a bad idea. If you use a credit card that you absolutely, positively must pay at the end of each month and you carry a zero balance, then that's the proper use of credit cards, period. End of story. I'm going to talk to you a little bit about retirement plans. And I'm not going to say that retirement plans, whether they're tax deductible or whether they're not tax deductible, are a good thing or a bad thing. But what I want to talk about is things that you must know. Just things that I consider black and white, hard and fast rules and truths about retirement plans. especially those that are tax deductible, so-called. Here's point number one. If you don't know exactly what your tax bracket is today and can't identify it and monetize it and put a calculator to it, then you have no idea what the monetary benefit is of a tax deduction. So if you're in a low tax bracket, if you're married with a few kids and you're making moderate income, let's say $100,000 or less, your tax bracket is extremely low. And you'll have to talk to your tax preparer to find out if that's true. It's probably true. So a retirement plan may have other attractiveness. It may have other reasons, other good qualities why you want to have a retirement plan. But understanding your tax bracket is just black and white important. And number two, if you don't pay any income tax, if you paid no tax last year, if you got your tax return back, you filed your tax return, and you had a net zero tax, you cannot expect a tax deduction. Now, many people may be surprised by this. And I guess some people assume that tax benefits come out of the sky. In order to have a deduction, you have to have taxable income from which to take that deduction. You won't get any advantage otherwise. Number three, if your employer matches your contribution 100%, that is not the same as getting 100% rate of return on your money. You need to go a little bit deeper and understand exactly what's going on. A match is a match is a match. A match is very lovely. A match is not guaranteed next year. You may get a match this year. You may get a different match next year. Your employer may discontinue your retirement plan a couple years from now. They can do that if they submit the request to the IRS, and in most cases, those requests are approved. So don't assume that your retirement plan will always be there. Don't assume that you'll always get a match. Number four, you cannot know your future tax bracket today. Whether it's higher today or lower today, it makes no difference. No one knows what the tax brackets are going to be in the future. Now, I listen to and read some very bright people who tell us that this government cannot sustain itself without continually increasing tax brackets, tax schedules, tax collections. There's a good reason why they hired 80,000 new tax collectors, if they did. Next item, I think I ran out of numbers. $1 today is absolutely worth more in purchasing power than $1 in the future. So when you put $1 into any future return vehicle, you're putting $1 that has more purchasing power today with the expectation that you're going to get more dollars in the future. But understand that each of those dollars will have less purchasing power than each of those dollars has today. Next, when you borrow against your retirement plan, you must pay interest on the loan. Now, most people don't see this, but you've got to pay interest on that loan with after-tax dollars. So the dollars that you borrow against are no longer in the market or the specific market account that you chose when you set up the plan. Those dollars are set aside. It's a little bit more convoluted transaction that you should understand before you take a loan. You should talk to the person who arranged the retirement plan at your work, or talk to personnel, talk to the people who are in charge. No matter your retirement plan balance, and you should know what your balance is, not only should you know what your balance is, you should understand where the return came from when you get your statement that tells you you made X percentage of return for last year. More importantly, you should know how much you put into your retirement plan. It's amazing to me that most people can tell me what their balance is today, but most people have no clue how much they put in. If you don't have any idea how much you put in, how can you figure out if you really had a gain? I think it would be incumbent upon you to understand how much you put into your plan. Now, a separate issue is the discussion of the tax. Well, if I cash my plan in, and I'm not suggesting anybody cash their plan in, We're talking about the way plans are built and things that you should know about your retirement plan. But if I had cashed my plan in, hypothetically, I would have to pay the tax. Well, that's true and it's not true. You paid the tax when you made your contribution because that supposed tax deduction that they told you would have is on your tax return, but the tax is embedded in your retirement plan. The proof of that is simple. If I cash my plan out, the tax is separated from your proceeds. So it's not that you have to pay the tax if you cash out at a future point in time. The tax resides inside your plan. You're carrying a tax burden inside your plan. And if your plan makes an earnings or a return, then that tax amount will also make a return. That tax component is not yours. It was never yours. It never will be yours, assuming that you'll be above a zero tax at some point in the future. Two opposing statements can't be true. I can't be in a lower bracket in the future, but disagree with the statement that there is a tax embedded in my plan. There is absolutely a tax embedded. Next item, your family will absolutely pay some tax on the entire plan balance if you die and leave your plan to your family. You do not get to pass your retirement plan balance tax-free to your family. It's a common misconception. I've heard that assumption expressed to me by attorneys, by other professionals, including financial professionals who don't know the details about their retirement plan. All this to say, you need to study the plan that's being presented to you, and you simply need to understand what's being shown and what's being suggested that you enroll in for the next 10, 20, 30 years. It's a known fact, I think this is more commonly understood, that you will be subject to penalties and taxation should you withdraw your money from your retirement plan before the age of 59 and a half or after the age of 73. So there are restrictions and penalties for taking out money before and also for leaving the money there too long. You can't have it continue to accumulate and not take minimum required distributions after the age of 73. You must go to your plan administrators and find out the details so that you can understand what it is you're investing in. Unfortunately, almost half of Americans have loans against their retirement plans, which defeats the whole purpose of having this plan. Why in the world would you have a loan and have to carry the payments on that loan if you could have just separated those financial requirements from your retirement plan? If you're going to commit to a retirement plan, get your money for lifestyle and other needs from other resources, and learn how to budget differently, set up additional savings accounts. These are much more complicated topics that we can discuss in a few minutes on a podcast. But we are here to discuss those with you. I am slowly growing into the description that I'm a financial warrior, and I have the scars to prove it. These are facts. These are truths about retirement plans. I'm not saying you should have one or not have one. I'm saying that you should do your investigation. You should do your research. You should do the math. You should understand any financial program or any financial offering that anybody ever suggests to you, including myself. I hope you continue to follow us. And we'll see you next time.
This is thepodcastfactory.com.